Hello and welcome, and this week's stock analysis is Intel. Let's find out about the company. Intel was founded in 1968 and it was later IPO'd in 1971. Intel designs, develops and manufactures and sells computing and related products and services to the United States and internationally. During our stock analysis, we're going to explore the key pillars, examine the ownership, look back at past results, we'll find out what the analyst predictions are, as well as giving the business a valuation, and examine the potential return on our investment, and finally we will summarise our findings. Let's start by looking at the key pillars for the trailing 12 months. In the book Rule 1 by Phil Town, he suggests that these are the key metrics when first evaluating a business. The first pillar we are going to explore is the earnings per share. This is where we take the net income and divide it by the shares outstanding. The higher the number, the more profitable the company. Earnings per share is up an incredible 141% for Intel. Now let's look at the free cash flow, which is the money a business can generate from its operations. Their free cash flow is up by 14%. Then we come to the next pillar, which is revenue, and this tells us how good the company is at generating income before deducting expenses. Intel's revenue has only gone up by 2%. Book value is calculated by subtracting the total liabilities from the total assets, and this indicates the equity growth for the company. And in the last year, their book value has only increased by 1%. Now we want to turn our attention to the management of the business by looking at the return on invested capital and the return on equity. These two measures allow us to assess a company's efficiency at allocating capital under its control. The return on invested capital and the return on equity is up by 2 and 4%, which ideally we want both of these to be over 10%. Now we move on to debt, and Phil Town prefers a company that is able to pay off debt with their free cash flow within 3 years. Intel currently have about $52 billion worth of debt and are currently making a loss, so they can't use their free cash flow to pay off the debt. Whilst their free cash flow is up by 14% this year, it simply means they are losing less money this year than they were last year. In this next section, we will now focus on other key metrics which will help define an excellent business. Now let's look at the gross margin, which is the amount of money a company retains after incurring the direct costs associated with producing the goods it sells and the services it provides. Intel's gross margin is 41%. Next we come to the operating profit margin. This tells us how much profit a company makes on a dollar of sales after paying for costs of production, such as wages and raw materials, but before paying any interest or tax. Intel's operating profit margin is 7%, and ideally we want this to be at least 15%. For Terry Smith, free cash flow yield provides a more realistic view of a business's financial health and profitability. He typically looks for a company that has a free cash flow yield of 5% or higher. Their free cash flow yield is minus 9.56%, and basically this means they're losing a lot of money. After that, we come to the PE ratio, which Peter Lynch believes is a key indicator when evaluating if a company is under or overvalued. And lastly, we come to the enterprise value divided by earnings before interest and taxes. Like Peter Lynch, Joel Greenblatt uses this metric to identify if a company represents value for money. The PE ratio is a little high at 32, whereas the enterprise value to EBIT is incredibly high at 253. We'll come back to Peter Lynch and Joel Greenblatt's valuations later on. This is Bitesize Investments, giving you a step-by-step approach to your investment journey. There are currently 3 super investors who own this company. If we look back at Jim Simons' previous sales and purchases, we can see he has both bought and sold shares in Intel in the last quarter and has bought 2 million shares, having sold 5 million just before that. However, 12 super investors have sold their shares. Joel Greenblatt has consistently bought and sold shares over the last few years and sold off Intel when it was dropping in 2022, but bought 25,000 shares when it hit the market bottom, and in the last quarter he has sold 13,000 shares. Now we look at the past historical prices of the company, as this will help us build a picture of periods of success or failure the business has been through. Over the last 10 years, we can see that Intel was going up nicely up until 2021, and then they had a big sell-off in 2022, and are still in that process of recovering from that time. So let's see what the analysts think. On average, the analysts believe that the price target should be about $41, but some believe it can go as high as $66. Analyst reports suggest that Intel is currently undervalued at the moment, and the overall consensus is that Intel is a hold. And collectively, the analysts believe that the company will grow between 10 and 117% over the next 5 years, depending on which analysts you believe. So I'm going to use the current earnings per share of 0.97 as my starting point when creating a valuation. Based on a combination of past growth and future analyst predictions, I'm going to estimate the earnings per share growth will be about 16%. I'm going to give Intel a PE of 38. After that, I'm going to project these numbers forward by 10 years. This gives me an estimated future stock price of $161 per share for its future share price. Then we need to include our 15% return. Then we work out the current value, which Philtown calls a sticker price, which is $40. Then we apply a margin of safety, and at 50% it gives me a buy price of $20, or at 20% it gives me a buy price at $32. As we can't rely on just one valuation model, I'm going to dig a little deeper and gather some more information. In this next section, I'm going to get some help from some super investors. To start off with, I will use the Peter Lynch PE ratio model to help determine if the share price is overvalued, fairly valued, or undervalued. So we take the share price, add the dividend yield, and divide it by the current PE ratio. Using this model, it suggests that Intel is overvalued. Then we're going to move on to Warren Buffett's 10 cap model, where you divide the free cash flow with the market cap. The higher the percentage, the more the company is undervalued. Using this model, it suggests that Intel is significantly overvalued. After that, we're going to move on to Joel Greenblatt's favourite tool for working out if a company is correctly valued, which is dividing the enterprise value by the earnings before interest and tax. In Joel Greenblatt's method, this also suggests it is highly overvalued. Finally, I've also included Philtown's earnings per share growth model that I used earlier. Using the Philtown earnings per share growth model, it suggests that Intel is a buy at the moment, but only if my assumptions are correct. Therefore, I'm going to look at the stock chart to help me gauge which zone Intel is currently in, as I need to decide if Intel is recovering or if it could drop further. If you're interested in reading any of the books by the super investors I've mentioned today, please look in the description to find out more information. In this next section, we're going to split the chart into different zones. Our first zone is the market bottom for Intel, which we currently seem to be in, which is about $25 to $36. Then we come to zone 2, which is between $36 and $44. And then that brings us to zone 3, which is between $44 and $49. And finally, zone 4 is our potential exit strategy when the company becomes overvalued, and this is a target price of over $49. The return we would receive if we had bought at $31 and then sold at the market high of $51 would give us a return of 65%. We would see a return of 89% if we had bought at the 52-week low of $27. From 2010 to 2018, Intel had a monopoly on developing and providing CPUs throughout the PC universe. However, with competition from AMD and Apple developing their own M chips, Intel is no longer the #1 CPU provider, and therefore no longer have a moat. Their revenue peaked in 2021 and has since been dropping year on year, which has seen their operating profit margin drop down to 1% from a high of 33% back in 2018. From 2014 to 2021, their free cash flow yield was on average 9.38%, and now it is currently minus 9.44%. Currently, they are trying to prevent any further corrosion by developing their technology innovation, increasing data expansion and manufacturing, and developing strategic partnerships with other companies. Finally, let's summarise what we found out about the company. When reviewing the key pillars, Intel scored 3 out of 12. Under ownership, 3 super investors have bought in the last few quarters and 12 have sold shares. In the past 2 years, we can see the average share price is starting to recover, but will it continue? Analysts are indicating that Intel is a hold, and they're predicting they will grow between 10 and 117% over the next 5 years. With such varying predictions, it really depends on if the remodeling Intel are currently going through works, or if the permanent damage has been done. Using the different valuation models, my personal buy price will be $32 or less, but I only want to buy companies that are the best of the best, or have a huge amount of potential and come with a superb leadership team. Under competition, Intel no longer have a moat and are currently going through a transitional period. My final overall rating is 2 stars out of 6, and I have given this a category E rating within my own stock watch list, which basically is my avoid pile, as I personally feel that Intel have missed an opportunity to strengthen their position when times were great, instead of waiting until they're in a position of weakness before they've decided to pivot. Thank you for joining me during this stock analysis video. As I'm a relatively new channel, please consider using the comments section to help me develop the content I'm creating. And lastly, if you've enjoyed the video, it would be greatly appreciated if you could like and subscribe to help the channel grow.